Good day, everyone, and welcome. Thanks for joining us today for a timely conversation on two of the most dynamic themes in real estate and tax-advantaged investing. We're speaking about the evolving build-to-rent marketplace and year-end strategies for opportunity zone investing. We are heading into the final stretch of the year. Market has been at highs, a little bit more vol now. Most assets have seen significant appreciation. There are gains to be captured or already realized or planned for sales before year end. So what we want to do is talk to you about opportunity zone investing, a variety of tax optimization strategies that can be applied. Let's talk about probably one of the hottest market segments in real estate, build to rent, with our partners at Trilogy. And what we want to do is unpack all this and give you some actionable insights that you can take advantage of before year end. So we'll put the obligatory disclaimer up. And then with me today is our colleagues from Trilogy, our co-GP sponsors for an actionable OZ fund that we'll talk about in just a moment. We've got the CEO, Jason Joseph. We've got David Baer, EVP of Investments and Structured Credit, and Austin Lee, the Vice President of Investments at Trilogy. And I think, Jason, if I'm correct, the last time we convened a forum like this, you were half the size, meaning you've doubled the business.
I've
So,
also gained some weight too, Jeff. Thank you very much. I appreciate that. Yes.
well, Trilogy is a fast growth company, a lot of meaningful updates to talk about within their business and within the market they participate in, exclusively build to rent. So those are our speakers today, and our agenda will be to talk about us briefly and our track record, but most importantly, talk about OZ 1.0. We distinguish 1.0, the current legislation still in force, versus 2.0 and year-end planning opportunities. And then we'll get into BTR, the market macro, and then specifically, really our actionable fund is executing on this theme of OZ tax advantage investing with build to rent. We expect to be generating attractive rates of return in a tax advantage manner. And then we'll close with a look ahead into 26. So briefly, I think most of you know us, Pinnacle Partners, recently nominated once again in the top 5% of all opportunity zone fund managers, according to Novogradac. We're in excess of 300 million of AUM and capitalized north of $1 billion of multifamily in opportunity zones nationwide. We're registered with the SEC, which gives us those belt and suspenders that give our investors comfort and confidence. We'll speak to Trilogy in just a moment. As I mentioned, they are fast growing with a lot of interesting statistics before them as we get into the BTR market update. Opportunity zone investing has, policy has made it now permanent as part of the OBBA. The 1.0, as we call it, the original legislation still in force and active. You can see, according to Novogradac, attracting significant amounts of investment. It's still the most significant tax shield ever enacted by Treasury. It accommodates capital gains from any source. It's not specific to real estate. It's not specific to any other type of asset class, but any realized gain, short or long term. And our prediction is now, with permanence being established in the OBBA, that opportunity zone investing will democratize real estate, institutional real estate investing for individuals, much like prior regimes who enacted permanence for QSBS democratized, say, venture investing. I won't spend too much time on that, but suffice it to say, permanence, policy stability makes this an ever-present tax shield that everyone should consider: individuals, RAs, family offices, anyone realizing capital gain events. The tax benefits are very much available to anyone investing that short or long-term capital gain. You get to defer the tax associated with the gain. You invest all or part of the gain into, say, our fund to get exposure to BTR and Trilogy's execution. We will take full advantage of the new OBBA condition or term rather associated with bonus depreciation. In the opportunity zone, we use depreciation throughout the holding period and do not recapture at terminal sale. This is a massive tax efficient condition of the opportunity zone. And then lastly, at terminal sale, when we look to sell the asset, the portfolio will describe to you the all investors are tax exempt. There are no capital gains associated with the appreciation of the underlying real estate. This is quite significant. The imputed value of these benefits range between 400 to 600 basis points lift to the targeted IRR. Eligible gains, one more time, obviously, any sale of stock, sale of real estate, a business, crypto, more recently was on a tear at 128. Even carried interest held less than 3 years characterized as short-term capital gains. And partnership interests, interests you may obtain from a mutual fund. I call these hidden gains. And I would encourage you to take a look at your mutual funds this year for maybe outsized gains given the market reached highs. And partnership gains within LLCs. They carry a different qualification period. Certainly can contact us for the various qualifying periods for partnership interests. And then lastly, I want to talk about something that differentiates this offering from any other offering or most offerings, I will say. We have a co-GP partnership with Trilogy. The relationship began almost 5 years ago. We're executing on two other projects very successfully in a prior vintage fund. Given the way in which we collaborate and partner, we in the partnership to offer this current actionable fund, the BTR fund, we'll describe in detail. Given our relationship and given our desire to offer to our LPs really a more attractive rate of return, we went to a single promote economic structure or waterfall. So that is promote between us, it's shared, and then there's no other promote. In traditional funds, there's the project level promote given to the developer or sponsor, in this case Trilogy, and then there's a fund promote, aka double promote. By invoking the double promote, obviously we're taking a large chunk away from the investor returns. Not in this case, we're offering a single promote. So what we're going to talk to you today about is an actionable fund that is, we've taken a lot of risk off the table. It's available for your consideration for those that have already realized 2025 gains, made planned sales before end of 25, and get involved in an exciting asset class that has a yield on cost, or let me flip that and translate that to investor terms, has a higher rate of return than potentially any other fund available in the marketplace before tax benefits. And this is the actionable fund. I want to introduce our friends from Trilogy. Jason, the business has doubled. Certainly, why don't you share with us the great growth and story behind Trilogy?
Yeah, absolutely. Thanks again, Jeff, and thanks everyone for having us yet again on. It's always a great when we have the opportunity, excuse me, to present the success of our partnership, both previously and where we're heading with the BTR fund as well. So Trilogy, as noted, founded in early 2021, coming up on our 5th year anniversary. And as Jeff mentioned, over the last few years, we have literally doubled each of the last 3 consecutive years. And so as we sat here last year, and as we sit here now this year, as we end 2025, as you can see, $250 million worth of equity invested, approaching just under $700 million worth of transaction, i.e. project cost, with over 20 communities operating or under construction to date. So as you look at it, our principals across, we've grown. We sit just north of 40 full-time professionals. We are also a fully vertically integrated platform for both acquisition, development, and the construction of the homes themselves. We actually recently acquired a home builder a little less than a year ago, been operationalizing that across 4 southeastern states, and now have had the privilege of being vertically integrated, which creates not only competitive advantage with trades, it also time. We always say time, cost, and ultimately delivery quality gives us that advantage. So as it looks from a deal flow perspective, as outlined here, our national, and as we say, we go as far west as Phoenix, out of Atlanta, actually just north of Atlanta and Alpharetta. And so right now, our site selection team has been covering, although across the U.S., we've been targeting the Southeast and really across the Sun Belt. And that's where we've seen most migration. And many of you know, if you've been investing or at least covering the U.S. market, this is exactly where we began from COVID. And then as we entering into this interesting new, what we'll call arena with the interest rates environment, what we're seeing heading into 2026. And what is critical here is that are exclusively focused in residential housing. We don't jump around into retail. We don't jump around into office. We are, and the core of our business has been built on build to rent. And although we've expanded our capabilities into land development, into home building, et cetera, BTR is ultimately the foundation for our company. We think it's important, all of the information and data that rests out. I think it's important to understand that build to rent communities are ultimately what is originally fashioned as a derivative of multifamily, where we're really exclusively focused on single family, i.e., townhome, which are attached single family dwellings, or detached single family dwellings in a complete community designed specifically for, if you drive by it, you wouldn't even notice that it was the difference between a for sale and a for rent neighborhood. But what's really interesting about what's happening across build to rent is that when you look at the 16 million single family rentals comprising in the United States, comprising 33% of the rental market, what's interesting is only 71,000 of those 16 million BTR units started over the last 12 months, which is really around 2% of the single family rentals institutionally owned, making it one of the most, what we call, this is an interesting line here, the most fractured asset classes in the real estate sector. Yet, as you'll see, between cost, return driven, i.e. rents relative to expenses, and what you'll see here is that BTR is now one of two favored real estate asset classes where both allocators, both private equity, insurance companies, private investors, et cetera, are seeking to place their dollars into. So we're really excited about, although the last few years with the interest rate environment have been challenging, what we'll see here across is that BTR communities on the whole have a premium rent relative to traditional multifamily. And we always like to say this, in that multifamily traditionally and holistically as an asset class is purpose-based and needs-based rental housing. Build to rent communities, for the first time over the last 6 to 7 years as the asset class gained institutional traction, created a renting profile. So when you look at this and you look at the survey across the BTR communities across Georgia, South Carolina, as you see here, what we found is that you literally had and I hate to show 69%, the average monthly rent premium ranges between 10 to 25% across the markets that we rest in. So if you think through that, on average, we are seeing a premium to multifamily rents. So likewise, when you see the rising interest rates for mortgages, et cetera, if you think through, at one point I was going to purchase this $350,000 to $400,000 home. Now that the interest rates have widened and continued to stay relatively high, you're looking at, on average across the U.S. in the BTR community, the same home relative to what's renting, you're looking at around $1,000 cheaper to rent across this type of home than it is to own. And so what's neat there is as you look at sort of these 5 bullet points, what we also have found is very uniquely is if you think about the turnover cost of a renter coming in, the use of the unit, the repairs and maintenance, freshen up the paint, maybe damages, et cetera. When you look at the acquisition cost of a new tenant, and then you look at the tenure of their lease, when you look across SFR, BTR, you're looking at an average of 3 years on the weighted average lease term, which compared to multifamily of 1 to 1.5 years, you start to look at the stickiness of that tenant and the stickiness, the long term. So it costs less to acquire, it costs less to operate, repairs and maintenance costs generally go down. And so it's a super interesting opportunity, whereas you look at across, and we always summarize as, one, you've got a better renter profile, you've got the costs is widening, own versus rent, you've got premiums to those rents, and you've got lease terms that are longer. And so it really creates a unique opportunity in this asset class. So when you look about the drivers, the housing, and we always say housing shortage, we all know statistics say 5.5 to 6.5 million homes on the shortage. the affordability crisis we've all obviously been witnessing. A little bit repetitive here with respect to starter home cost at around 1,000 a month. And it's interesting, depending on what market you're in, that obviously can increase quite dramatically. If you're in Phoenix, if you're in Texas, if you're in Atlanta, those obviously shift up and down. And one of the most, to us, staggering statistic that's come out recently is the renter age is now years of age, up from 33 in just 4 to 5 years. So when you start to look at what's happening and widening that gap, what it also means is that that demographic profile typically has better wages. It has, once again, stickier, I want to be here for a longer period of time. And so that renting by choice really creates something interesting there. So I want to pause just real quick. And Austin is one of our, what we like to call our resident economist in our, would you like to add anything to that, Austin, as we're kind of thinking through this?
Yeah, just a summary of just all those points where you have a 40% increase in monthly payments. The affordability between renting and buying is over $1,000 and has been for some time. New home purchasers made up only 21% of all purchases in 2025. And then you combine that with the target demographic. Now it's other ones outside of that, but the millennials ages 20 to 39, that used to be when you get to the end of that age group, you were a first-time home buyer. That is pushing out longer and longer and longer. So you combine those, and that's where we really think, this segment of build to rent is really going to have a long runway of growth.
And if I may interject,
Yeah,
Jason,
go ahead, man.
scattered SFR here to the right on the chart
Yeah,
became institutionalized with Colony,
2008. That's correct.
2008,
That's
post
right.
GFC. That became ultimately very attractive to institutional players. They would aggregate these scatter sites, create a portfolio, and they monetize that quite significantly. And BTR is also gaining institutional interest, and
Exactly right.
notable names that are allocating literally billions of dollars into this product category. Is that correct?
They are. And in 2008, it's a great point when the great financial crisis hit in this, what we would call an oversupply of homes that were basically sitting on the ground. The alternative use, when financing didn't exist, the liquidity in the market had dried up. The opportunity of buying the inventory that was there and creating an alternative use, i.e., renting them. So a scattered could be any home, anywhere, single location, single address. And what happened there was, as that became known and that renter profile began shifting, these were folks that weren't renting apartments. These were folks that wanted to lock and leave in an opportunity to rent in an area. Maybe it's transitional, maybe it's migratory, maybe it's job change. And then all of a sudden, as that asset class institutionalized, then it was, well, what happens? How can we build purpose-built communities that are not scattered but are contained? And that's when this is a great, chart as you look at it, where the conventional multifamily, larger space, when you see the X's, we like to say these are the comparative sort of components, backyards, garages, rooms for your dog, rooms for your pet. But also having very similar, if you look the quote neighborhood feel, if you look at the attached garage, the private outdoor space, noise privacy, all those different components to it. And for us, that's also interesting is, and very normally is overlooked, is eligibility financing. So we said derivative of multifamily. Now we have this opportunity of agency Fannie and Freddie financing as these things stabilize, which ultimately, if you're looking at a P&L between a multifamily and a build to rent, you ultimately can't tell the difference because they're both structured accordingly. But that scattered single family rental, ultimately not being eligible for agency financing creates a buyer pool in build to rent that's equivalent to the multifamily sector.
Very good. This is your capstone slide. Anything else to add on the
No,
macro?
no, absolutely not. No, I think that this does a great summary, as we look through it. And I do think what is interesting is when you look at supply on the second to last bullet point's important is that the occupancy across the last 3 to 4 years, as migration has also slowed, and you'll see some headliners around supply and other BTR occupancy literally is still sitting at 95+% nationally. And so it's been an asset class that's held well with people sticking tight.
Yeah.
So, this is an evolution from SFR. It attracted institutional attention and became a very attractive asset class. We now have BTR purpose-built communities. People want all the amenities you described and proximity to schools, other services, right? They're no longer interested in vertical, higher density, traditional multifamily. The yield on cost, that is the ability to build at an attractive cost, is substantial, right? We're not excavating parking, it's surface parked.
That's
And
right.
we're focused here in this particular curated portfolio to build townhomes,
That's right.
which
That's
provide
right.
that little bit of, again, proximity to schools. So very attractive and emerging product category in the real estate marketplace.
It is. And I think when you look at, if you go back to the just previous slide real quick, if you look at a couple different points in Austin, I think this is some really important data here. Do you want to kind of talk through? Because I do think that absorption, and when you look at relative
Yeah.
supply, permits that are down, the opportunity that we have is we're delivering product into what will be less supply and an opportunity to create both acceleration and occupancy as well as rent growth. Do you want to talk through that?
Yeah, absolutely. And I think there's two things to touch on there. The first is that, Jeff, that billions of dollars are flowing into build to rent. While albeit true, the market size and the market share for build to rent still has such a long way to go in terms of absorption. The any oversupply that there might be able to rent is going to be absorbed much faster than multifamily. There was roughly a little over 400,000 units of multifamily delivered over the last 12 months. There was 71,000 built to rent. So it's really just a drop in the bucket on in the overall asset class of rental housing. The other piece is it's a pretty staggering number of this year. The cost of home ownership has driven 970,000 new renter households compared to 390,000 new homeowners. And that's a trend that we expect to keep going and even increase in that gap to widen over time to the point where we're actually projecting to see a 50% rentership share of the market by 2029. And that's something that is completely flip-flopped from historical norms due to the affordability issues of for sale housing.
Thanks, Austin. This is in this slide actually articulates it well when you start to look at the BTR institutional investment. And really, I think what's interesting here is when you look at the deal participants, Rightwell, Tricon, Invitation Homes, JP Morgan, et cetera. The interesting part here is to show the institutionalization of the asset class and the attraction of money into the space. This same list of quote unquote buyers have similar allocations into multifamily, into industrial, et cetera. So this is to show the type of deal volume and deal participants that are pushing into the BTR investment.
So I said at the opening that opportunity zone investing with now permanence will democratize real estate investing for individuals to participate in institutional quality assets. This is case in point. JP Morgan and Tricon, they will raise capital from institutions, and that is pension funds and life insurance companies. Think PGIM as an example. And we are offering institutional quality assets curated in a boutique portfolio of 3 projects made available to individuals. Okay, institutions cannot execute on opportunity zone investing. They are tax exempt. The tax benefits are delivered to the individual.
It's a great point.
So now we collectively have an opportunity to invest in an exciting category that otherwise is dominated by institutions up and down, and we get our fair share of that in a tax advantaged mechanism. And that's what I consider to be the democratization of real estate investing into institutional class assets. So here we are. Let's talk about them. This curated portfolio of 3 projects to deliver townhomes in 3 submarkets that are experiencing significant growth.
Absolutely. And it's interesting when you look last year in the germination of this fund, Jeff, now we sit here in November of 2025, and the most unique portion of this is, the why factor. Obviously, these are southeastern markets. Decatur, obviously being a suburb of Atlanta. Augusta, 2 hours to the east of Atlanta. Why Augusta? Huntsville, another 3 hours away in Alabama. Why Huntsville? And you start to look at these these developments in these locations must stand on their own, independent of the tax benefits that are afforded through opportunity zone investing. So the most critical piece of this is these were independently looked at, these were independently underwritten, And we saw when you look at the growth opportunities in these markets, and then ultimately between our investment committee and Pinnacle Partners Investment Committee, merging those two and selecting these three, we're at a really unique place here where, now all three of these locations are now owned by the fund. Decatur, as an example, the horizontal construction has already begun. Vertical construction will begin the first of the year. Augusta, fully zoned, entitled, and permitted, ready to break ground. Huntsville, horizontal development complete, all lots ready. First quarter next year in 2026, we'll begin vertical construction for those homes. So the interesting part is an enormous amount of the risk profile of development when you look at the three components, one being zoning entitlements and permitting, two being the horizontal development and construction, and three being the vertical. All three of these have met zoning entitlements and permitting. Two of the three, the horizontal is quote unquote complete. And now we enter into the next phase of vertical construction. So we're very, very excited about where these three projects today. And in subsequent slides, we're going to walk through the market specifically and answering that question, why? Why Decatur, why Augusta, and why Huntsville?
Yeah, so the first project is in Decatur, Georgia, obviously in the Atlanta MSA. There's a lot of obvious reasons to be in Atlanta, but Decatur is one of the fastest growing sub-markets of Atlanta. And then there's a couple of good reasons why, particularly for our location. We're located right on the 285, what we call the perimeter, that runs all the way around Atlanta and touches every one of the major submarkets. Gives you great access to the airport. Obviously, as we know, Delta is headquartered in Atlanta, so you can get to the airport in 20 to 30 minutes, depending on that Atlanta traffic. But there's a couple other things where, Decatur offers great access to Emory University. It's about 10 to 15 minutes away. Downtown Atlanta and Midtown Atlanta host companies like NCR, where
Can you go to the next slide real quick, if you don't mind, who's controlling? There you go. Thank you.
Oh, yeah.
Yep,
yeah.
Go ahead,
it has 16 Fortune 500 companies. But there's a little known kind of the trends of Atlanta becoming a tech hub for the Southeast, where 70% of all financial transactions actually go through fintech companies that are headquartered in Atlanta. So there's a huge opportunity for growth there on the side and the tech side. And not only that, Decatur's kind of in the epicenter of all of it, able to access great access towards Midtown, 20 minutes to 30 minutes to the airport, 15 minutes to the CDC and Emory University. So it's in a really, really great location, opportunity to access to all the major employers.
So if I may interject without digressing us, a lot of excitement about OZ 2.0. And as you may or may not know, that's a program that begins Jan 1 of 2027. It will establish new zones. It will designate new maps
Great point.
based on 2020 census data. The arbitrage we saw at Pinnacle early days 17 is as we began to look at the maps very closely, those maps were based, we'll say OZ 1.0, based on 2010 census data. So already 7 years and now further, 15 years in total, whereby there's been a lot of, emergence of some of these submarkets. So here we are at Decatur, just outside of Atlanta. It's an opportunity zone based on the 2010 census data, and 1.0 has deemed it OZ. So that's what's so unique about the current program and the maps in place and the ability to execute on 1.0 and with this fund. So just a call out here to Decatur, which is, as you suggest, just outside of Atlanta with all these diverse economic drivers.
That's great.
Absolutely.
Thank you,
Augusta's it's one that we're really is a very good reason why. In Augusta, more as you see towards workforce housing. And the big reason why is Fort Eisenhower. Fort Eisenhower is a base that's about 8-minute drive from where our location is. And Fort Eisenhower is the new U.S. Army Cyber Command. So there was 6 cyber command centers around the country, and they decided to implement and aggregate all of them into Fort Eisenhower. And as we know, cybersecurity is going to be on the forefront for growth and is really in for not just the government and the military, but all business in general. So Fort Eisenhower right now, as it's continuing to grow, it employs 32,000. And the general rule of thumb for military installments that they have a 2-to-1 on base and civilian contractor to indirect jobs. So the total kind of ecosphere that Fort Eisenhower has is actually 64,000. And the fort is really ramping up, having $2 billion of improvements over the next decade, total annual impact of 2.4 billion. But I think one of the key things of why we think that this project is going to be so successful in Huntsville is that the base doesn't have any near-term plans to expand housing at all. As the government invests into the market, as private companies, as they already have invested $100 million into the Georgia Cyber Innovation Center in downtown Augusta, there's going to be a massive inflow of military and civilian contract and private business employment, and there's them to live. Augusta has, it's just now starting to get some quality rental housing, but it's far below the curve for the demand that's going to be there. So it's a really, really exciting opportunity to be of the growth of the cybersecurity industry.
One other quick point that I think is important with Augusta, and it was interesting when the investment team first brought Augusta to sort of a committee, to the collective team. The first question is why Augusta? And when you start to look at Cyber Command and their headquarters being transferred here, or centralized here, excuse me, and you look at that statistic or that statement around no real plans for housing, it's why when we started a few years ago assessing Augusta, the national home builders that have entered the market over the course of just the last 2 short years, from Lennar Homes to D.R. Horton, et cetera, when you start to see, it's like McDonald's, Burger King, et cetera, landing on a corner before anyone else. The amount of people and jobs that are coming to this area, and to Austin's point, is so undersupplied with housing, both on a for sale and for rent perspective. We see workers first and the opportunity for us. And as you look at the map where we sit, where you've got Augusta University, you've got the hospital system, the medical system, et cetera. You've got downtown, quote unquote, Augusta, and then you've got Fort Eisenhower. It's a really unique opportunity for us to deliver these units at a time that is just critically needed.
So let's just benefit of the audience. Let's talk about supply for a moment, right? We've got the rapid increase in interest rates in the prior interest rate rise regime, which caused a lot of developers to go pencils down, meaning
Right.
no activity. Permits had a precipitous drop, and so nobody's building net new product. I think that's macro condition. Yet we had control of land, then we acquired land, and then we went through horizontal construction, and now in the process of vertical construction. So we just got a footprint in these 3 markets, and I think as we execute towards vertical construction, ultimately lease up, we're timing the market. It always requires luck, but we may hit the market at the right time where there's very little new supply.
Right. And to your point, Jeff, as we mentioned in the market summary, and you'll see, I'm jumping ahead to the 2026 and beyond outlook, but the drop off of permits means there is a future drop off new deliveries. And to your point, while we're expecting 26 to be kind of a moderate uptick, both of these properties will deliver or start to deliver homes around the end of 26 to early 27, where we really expect that lack of new supply in the increasing demand to really hit an inflection point where we'll start to see significant rent growth again.
That's great.
And we'll close with Huntsville.
Yeah. So Huntsville, again, very, very exciting market. Kind of follows the similar theme of federal and government military investment, but our location is really one of the best ones that we think we can get in Huntsville. We're less than a 10-minute drive to Publix, which for those of you who are not in the South is our local grocery store, Safeway or H-E-B or the equivalent, close to a Walmart, a mixed-use development that has tons of entertainment opportunities, in less than 15 minutes to downtown Huntsville, and importantly, less than 15 minutes to some of the major economic employers there. So, it's nicknamed Rocket City because it has a long history of aerospace and defense. So, critically, Redstone Arsenal, it's the U.S. Army's center for their missile and rocket programs. It says there's 50,000 civilian and contract employees. And what's really cool about this place is in Huntsville has the Cummings Research Park, where it has Lockheed Martin, Raytheon, Honeywell. I mean, think of an aerospace and defense related company, and it's there. It has 26,000 employees. It's the second largest research park in the country, and it's the 4th largest in the world. So there's going to be a long period of growth there. Top five cities for per capita, which you probably wouldn't expect for Alabama, but that is absolutely the truth. And then NASA's also there. So it's a very highly educated market. There's a high concentration of talent in Huntsville specifically, and that shows with a 2% unemployment rate, 3% annual job growth, and with the strong federal presence. It ensures a kind of economic resilience and continued growth of the aerospace and defense industry. And we expect these trends to continue for a long time.
That's great. Outstanding. Very good. So we're moving into the Q&A portion of this presentation. So please the Q&A button and your questions. I want to conclude with a couple of things and do want to come back, Austin, to the 26 and beyond as it relates to BTR. So as it relates to OZ 1.0, I'll speak to that. Again, it's been an incredible year in the markets at large, with crypto peaking at one market at highs. We've seen some volatility of late, but nonetheless, gains have been realized, or you are positioning for gains and potentially even, looking at tax mitigation strategies as we conclude the year. OZ 1.0 has a lot of advantages. There are some other techniques and optimization strategies we are pursuing. We would encourage you, if you have an interest, to learn more about our fair market valuation evaluation, which could mark down your mitigated tax, the use of bonus depreciation after cost seg, and what implications, again, could be provided for even more tax efficiency. We are focused on bolstering this tax shield OZ 1.0, and we've got some techniques, we've got advisors, and we've got white papers and calculators that can assist you in making an informed business decision as you look to maximize your after-tax returns for 2025. And more to come on 2.0, and indeed futuristic, but again, now permanence, which I think will just further expand the market for opportunities on investing. Austin, do you want to also share with us kind of 2026 and beyond for the BTR market as we look at more questions coming in?
Yeah. So just to touch on the national permitting is down 16% the previous 2 years, roughly 14% down this year. So again, that's going to create a critical shortage in 27 and 28 is what the expectation. So that being said, what we're expecting, and this data is from John Burns, just to cite my sources here, is 2023 and 24 have been negative in rent growth, and everyone's seen that headline news. In 2025, we've seen relatively flat. I think we're 0.5% positive in rent growth. 26, we're expecting a bump at 2.1%, I believe the number was. But 27 and 28, we're expecting more than 3% rent growth per year thereafter until that supply and demand equation reaches once again. And again, and probably what is about the process is it's roughly a 24-month process from when you actually get something under contract, get it to permit, and then when you build something, it's even another 18 months after that. So you get homes in the ground. So if someone was to start today to try to get a permit, on a raw piece of land, it's 36 months until they have the opportunity to actually deliver a home. So we have a great opportunity here to deliver into that. Outside of that, I think I touched a little bit on the trends of rentership versus home ownership these days. Again, on how that effect of that is going to continue to drive demand away from the for sale market into the rental market as people are renting for a longer period of time in their lives.
Excellent, Austin. So I'm gonna ask you and Jason to opine on the next question. We have a question here, anonymous attendee. Feels a lot like investors are on the sidelines right now. What are you seeing? And
Great question.
I'd like you to again opine on, do you believe we're at the start of a new real estate cycle, or now that we are in a rate cutting regime, and given the supply constraints you just described, is now a good time to be investing in real estate? That may, for those sitting on the sidelines, they're probably trying to evaluate all of that.
Great question. I'll take it first and like to get opinions both or following comments from David as well. in Austin. What's interesting is I would say that the late 22, 3, and were periods of herd mentality, capital on the sidelines, institutional capital on the sidelines. I mean, obviously, we've seen over the years the stock market rage. And what's interesting is that when you look at where capital is being deployed now, I would say in Q3 of 25 and as we're in Q4 of 25, we've seen more activity from our institutional partners than we've seen in the previous close to 3 years. So we've seen the investor appetite, the investor activity. And if you think about some of the stats that Austin laid out with respect to supply and with respect to rent growth, that rent growth is a direct correlation to why the supply, as it drops and as demand continues to increase, and investing today, part one, into development to deliver units at the end of 2026 and into 2027 provides an amazing opportunity for that growth, which obviously correlates to great returns. So part one. Two, this was 2 weeks ago, sitting at a Goldman Sachs real estate conference and listening. We always say, who is the platinum with respect to opinions and data relative to where we see the economy going? The vice chairman of Goldman Sachs sat and spoke. And when you start to look at their curves, they're seeing as we end and think through it, transaction volume has been at an all-time low. Transaction volume being sale, buy and selling of real estate assets across all asset classes over the 2.5 years. And when you look at the transaction volume over the last 3 months, 90 days, increasing, you're seeing cap rates at 20-year highs that are now starting to creep down. They're seeing us in a period over the course of the next 2 years of real estate recovery. So the opportunity of both investing now and as that starts to climb, transaction volume going up, cap rates coming down, we're really, really seeing a unique opportunity right now, which is why we've seen, your direct question, Jeff, the investor appetite increasing exponentially. Last stat I'll give just from Trilogy's perspective, having 3 build to rent opportunities under construction, developments under construction at the end of 24 and into 25, as we into 26, that number goes up to 11. That number goes up to 17, 1,800 homes across those communities. Our business is growing, doubling, et cetera, because of the appetite of investors now wanting to move into this asset class. David, you want to add anything there, man?
Yeah, obviously spot on, and I'm kind of in the trenches with Jason day to day. So it's interesting to see kind of the uptick of activity over I would say the last quarter. I think we've all had the benefit of, investors sitting on the sideline being a seizing of transactions happening, and it's almost sobered us up as we evaluate deals and really seeing kind of what has happened with growth or kind of rent, decline in this case, and really being able to underwrite in a more kind of clear and sober way where a lot of confidence. I think our investors have a lot of confidence. And so it's not easy to identify these opportunities, but when you see the opportunities, investors are really responding positively and very aggressively, and we're definitely encouraged. I think Opportunity Zone is a different animal to point. It's a different. Institutional investors aren't necessarily participating in it, and there's other benefits to it. But generally speaking, the lack of development has created an even more need for housing. And so it's really just it's the right operators finding the right opportunities. The capital comes with it. So we've been very encouraged by it, and obviously are very optimistic going into 26.
Excellent. Great response from all three of you. Thank you for that. Another question in for investors who have multiple potential gains across different assets, how should they think about allocating into the OZ? Let me just establish that, again, OZ investing requires a realized capital gain, short or long term, from any source. So we talked about earlier in the conversation, it could be that embedded or hidden gain within your mutual funds. Check your statements. You may have top tick crypto. You might have sold an investment property, even your primary residence. Obviously, stock sales included. You can stack those gains, okay? You can aggregate that. They can be a combination of short and long-term gains. They all qualify for OZ investing funds. You are not required to invest all the gain. Crypto, or you might have sold invest part of the gain. Investment property, okay? And then primary residence. Obviously, we're suggesting, and I would encourage anyone who has interest to you can out to stack us. Those gains. These really interesting tax
You can
aggregation strategies, although
they
we're
can
not
be a
dispensing
combination of
tax
short
advice,
and long-term
but
gains.
you
They
can
all
carry
qualify
forward
for
your
OZ
losses.
investing.
Maybe
You are not
harvested
required
some
to
losses
invest
this year and
all
may
the
harvest
gain,
more
or
losses next
you
year.
can invest part of the
You
gain.
can use those losses
And
to
then
offset your
what
we're
for
suggesting,
capital
and I would
gains
encourage
tax.
anyone who has
And as
interest
I said
to
earlier,
reach out to
we're
us.
using
We've
techniques
got
like
these
fair
really
market
interesting
valuation,
tax
and the use of
optimization
bonus
strategies,
depreciation,
although we're not dispensing
to
tax
really
advice,
further
but
reduce
you
and
can carry
mitigate that
forward
tax
your losses.
obligation.
Maybe you've so the answer
harvested
is
some losses this year and may harvest more
should
losses
you
next year.
what is the allocation
You can use
equation?
those
That's
losses to
that's an
offset
individual
your
decision.
capital
You
gains
have this
tax. And as I said
maximum
earlier, we're using
flexibility
techniques like fair
across
market
a multitude of
valuation,
realized
and the
cap
use
gain
of bonus
sources
depreciation
and
to
commingling
really
short-term and
further
long-term
reduce
gains
and
if you
mitigate
choose.
that tax
So
obligation.
a minimum to invest in the project. So for the fund, I'd encourage you to reach out. It's $100,000 minimum of capital gain. Again, we're not, it doesn't matter what style of gain, type of gain, duration of long or short. So dollar minimum. And then another question coming in having to do with the 180-day rule. So remember, you realize the gain, you have 180 days to qualify for OZ tax benefits. I mentioned that partnership interests carry a little bit different clock. And so again, I'm encouraging anyone, again, to reach out to us. We've got a point of view on tax optimization strategies. We can inform you on the 180-day rule as it applies to very specific gains, including partnership interests. And obviously, we want to talk to you about this actionable fund. You can get access to the data room. You can dig in. And what we've been doing lately, Jason and I and Austin, with prospective investors, we get on the phone with you and we go and dig into the details of Decatur, give you the market comps on Huntsville. Diligence is robust and allow you to evaluate in an institutional way the investment opportunity before us. Thank you everyone for joining us. This has been a robust conversation on a variety of subjects. 2025 tax planning using OZs, an emerging category, BTR. We're so proud and pleased to have our partner Trilogy here and their success this past year and continued growth. And we will have, I'm sure, lots and lots of opportunity in the future together. Thank you, everyone, for your time and attention.
Thank you, everyone.
Thank you, guys.